Welcome back to Wealth Mavericks, the podcast where we help doctors unlock the secrets to building generational wealth. And today, we're talking about paying off your mortgage and when it makes sense for you.
We have a saying, income is taxable, cash flow is plannable. Why do they want us to be in debt? Because then you have to work, have to pay taxes.
Hi, Bob and Joe. We have a great topic today. It's one that is top of mind for many of our members and probably a lot of our listeners too. And it's this idea of paying off your mortgage and being totally debt-free. When we walk our members through what we call their Freedom Roadmap, when they lay out their 3 milestone goals, most of our members put this as one of their goals. And the question is it the best financial move? Or are there better ways to be investing your money? And like so many things we talk about, there's not a one-size-fits-all answer. There's some nuances to this. So today we're going to talk about when does it make sense for you? And what is Bob's take on this ultimate goal of paying off your mortgage? So Bob, we'd love to hear what you think.
Yeah, no, this is a topic that actually comes up quite a bit. And it's something that we ask each of our members as we go through this process because it is a hot topic, and you hear so many different opinions, just like with anything in the finance, right? There's opinions everywhere. And the key that you brought up is, when does it make financial sense for you? And that it's not a blanket statement. It is a very specific, personal, and even within couples, right, Aaron? We've been on a couple calls where we talk about this, and the couples have differing opinions, and not strong like this, I'm planting my flag type of opinion, but it's just like, well, this is my thought opinion, right? But we're open, and that's the amazing thing, is most people are open to this topic and what does this look like, and why would we do this? So I think to answer this question, we need to take a few steps back and look at this. Why do we have a mortgage? What's the whole point of it, right? And obviously it's to leverage, bank other people's money, a bank, to be able to allow us to buy a home that we want. Maybe not our dream home just yet, but the home that, or the house, we can make a home, right? And we're not coming out of pocket all the cash. But there's a cost to that. Just like all financing, there's always a cost. And so that is the interest to it. So here's a couple fundamental understandings of how the IRS or the government looks at it. Typically, the government will give you a carrot. They'll give you a tax benefit if they want you to do something, right? And typically, now that we know kind of how the government works, and some of the episodes that we've talked about and kind of how they've structured these rules, is why would they give us a tax benefit on the interest that we pay on a mortgage loan? Why do we get to deduct that interest as a deduction on our itemized deduction? It's on the Schedule A of your personal tax return, the 1040. Why do they do that? Because they want you to be able to, and this sounds a little snarky maybe, they want you to be in debt. And because when you're in financial debt, think about it, hundreds of thousands of dollars a financial institution gives you, and you are only have to pay $1,000 to $10,000, depending on the size of the loan, monthly over 30 years. Think about that. Now, yes, the bank gets interest. So the amortization schedule works where there's more interest the first month than the very last month, right? So there's less principal the first month than the last month. And so it kind of goes like this, interest and principal. That's what the amortization schedule does. So why do they do this? Why do they want us to be in debt? Because then you have to work. You have to earn a certain type of income. So you have to pay taxes. Okay. Now that may sound a bit cynical, but the reality is, think about it. Think about how many times people feel stuck and they are emotionally connected to their home. It's no longer a house. It's now a home. We've created memories. The kids grew up here, right? Think about those emotional connections. A lot of times we don't have those same emotional connections with other assets. And so we're always told that our house is an asset, it's an investment. Well, it's an investment in your family, in your home. It's only an investment or an asset when we understand the definition of an asset. So we'll use the Robert Kiyosaki definition of an asset, which is an asset is something that appreciates and actually creates income for you. Well, your house does the opposite. It's a liability. It's a huge liability. Okay. But let's go back to the interest and the deducting of an interest. So let's say, for example, you get a house and it's 6% interest, right? And you're tighten up the belt and we're going to do it. We're going to make this leap and we're going to do this because it makes more sense than just renting, right? So you do it. Let me ask you guys, when interest rates go down, what's the first thing people are going to do with their mortgage?
Refinance.
Refinance. We all know that. It's the first thing we all do. Why? Because it lowers the cost of that loan, the debt, the expense, lowers the cost of that money. Well, what happens to your tax benefit then? Just went down. So is it because it has a tax benefit? No. That's the initial carrot. That's kind of the I don't want to say the sales pitch, right? But that is the one of the motivating factor that people like, well, but we get to write off the interest as a deduction. So it's going to help us tax wise. But every month, as we said, the amortization schedule, the interest drops every month, right? So your tax benefit goes down. You refinance, it goes down even more. No. That's the game. That's the game. Now, am I saying don't buy a house? Of course not. But this is why this question pops up. Do I pay off my house? Does it make sense? Because we have some people like, well, we get to deduct the interest. Will that affect our taxes? Well, the interest rate is really low. Seems inexpensive. Why? I'd rather have that chunk of money go into other assets, other investments, and make money. Great points. That's why this is a personal conversation. So now that we have that background, let's talk about what this looks like moving forward and why would we pay off a house? Well, there's two scenarios. The first one, are you a W-2 employee or do you own your own practice or your own business? The conversation's different, immediately different. Here's why. Let's talk about the business owner first, I own my practice, okay? So when you take income from your business, from your practice, it goes into your checking account. Where does the mortgage payment come from?
Your checking account, or your savings account, or some personal account.
Some personal account. So what that means is that that money goes from your business as cash flow, flows through the tax man's hands for income taxes, into your personal account to pay your mortgage, and oh, but I get a deduction on the interest. That lowers each month, right? So your mortgage payment isn't just $3,000 a month, it's $3,000 plus the taxes you already paid to the IRS. So as a business owner, do you need that income if you don't have that mortgage payment anymore? Do you need that income in your checking account anymore? No. I don't need it. And so it can now stay as cash flow in the business. And so we have a saying, income is taxable, cash flow is plannable. So what we want to do as a business is have that cash flow, which comes from your revenue and expenses, right? We have that cash flow. We can now strategically shift that cash flow into other strategies to help grow your wealth as well as create tax benefits through the business. And so we've lowered the income taxes or the taxable income for you as an individual. Okay. So that's that stage. And so I highly recommend and encourage our business owners for us to put strategies in place. Now, don't just take a bunch of money and just pay it off right away. Okay. There's strategic ways to do this. We want to plan for this. The reason being is that the moment you take your cash and you pay off your mortgage, it's no longer your cash. You have no control over that money anymore to make money. So what we like to do is use other assets have these other assets, be able to have the access to the liquidity or the capital within that asset to help you pay off the mortgage. So you still have an asset that's appreciating and growing, but yet you've paid off the mortgage as well. Okay. And there's different ways to handle that and do that. So that's not this conversation's not for that. Okay. So that's the first thing. Okay. Any questions before I dive into the W-2 based on what I just said?
I wouldn't say I have any questions, but having been in the mortgage industry for a long time, early in my career, I'll tell you, people do get out of control with home purchasing and leveraging. I remember this was probably in the early 2000s. There were loans that would allow for a debt to income ratio of like 45%. And this is pre-tax dollars. 45%. 45% of your money pre-tax before you even start your month is gone to this home. And so I also think there's some elements to this, Bob, where the system that exists has encouraged more indebtedness in this arena. And I feel like we're seeing the same thing when it comes to automobiles. If you look at vehicle prices to own a vehicle, so there's some, I mean, there are trucks that are $100,000+. You know, it's like, so when you look at that leverage and how people are using, or I might even say misusing some of this, there are different decisions that can be made. Because to your point, Bob, the dwelling that you live in does not make it a home. There's more to making a home than the four walls and roof that are above your head.
That's right.
And so I think there's also some different ways to look at doing all this. So even with all that being said, I just wanted to add in that little element that there are different ways of thinking about everything, including how you're living on a day-to-day basis. But the other interesting element being in the industry, looking at the amortization schedule to what you're talking about, a lot of people don't realize, they just think the payment is applied equally. I mean, I know when you look at things, you will see it differently. But I remember adjusting and playing with, like, if we just add $50 to reduce principal on top of your payment, let's say your payment is $5,000 a month, and you just add $50 each month to reduce principal, it's crazy how much that shortens the length of the loan overall. So I think people are not thinking about these things. They sign their loan docs, they start making their payments, and they just don't think about it anymore. And even guys like Dave Ramsey will talk about, fine to have a loan on your home, right? They'll talk about getting to zero debt with a couple of exceptions, right? So I just think we can look at things a little bit differently if we choose to.
Yeah. Yeah, no, absolutely. So that's the business owner side. Now let's transition to the employee side. And I think that dialogue and that conversation of, well, I'd rather have my money go into another asset and appreciate and grow, because the cost of that debt is lower. So there is when you're talking about W-2s, there is more finagling with the numbers that we got to work with, right? Because the numbers have to prove that this is beneficial to do something. So this is where we start going into what we call our processes of cash flow mapping and asset mapping, where we're looking at existing dormant dollars that may be in a household that aren't being necessarily put into the right production or the right assets, right? And so there's certain strategies and structures to be able to shift dollars, have access to capital or equity within other assets to help reduce that home payment or that debt without suffering or hurting the appreciation or the value of the other assets. Okay. And so there's less, I don't want to say there's less strategies. It's just we have to be very mindful, because the key is you can't just make decisions to make decisions because I don't want a mortgage anymore. But yet it hurts your situation, the value of your situation. Mm-hmm. So it's not, in this situation, it really is not an emotional decision. It has to be a logical financial decision, because most people aren't losing sleep each night because they have a mortgage. They wouldn't have done it in the first place, right? Or they'd be aggressively paying it down already, right? Now, there is a hybrid to this that we typically will do with W-2 employees versus business owners, in the sense that we'll build up an asset and we'll chip away at that mortgage over periods of time. So we have to be mindful of where interest rates are to where we can actually utilize assets to do a lump sum pay down of that particular first note of the mortgage. And then if it makes financial sense to refinance because where interest rates are at, as well as the cost and closing costs of the refinancing, we got to take that into consideration, which yes, there's some tax benefits to it, but still at the end of the day, there's still costs, right? We don't want to just throw money out the door because, oh, I get a tax benefit. No. It's still cost out, right? So if your tax rate's 30%, that means 70% is your cost, right? That's still not a very good ratio to just throw dollars out the door, right? So, but does it make sense to be able to chip away that first mortgage? Now, the reason why I keep saying first mortgage is because it's a different product. That's the other thing is people don't understand there's different mortgage products. Just like there's different life insurance products, there's different investment products. Each of these products has a design to create a certain feature for our outcome, not a mortgage or a bank's outcome, which is how they usually approach it, but for you and I as an outcome. So you have your first mortgage, that product, right? That's the primary mortgage of most people. You can get a second mortgage, right? Or you get a home equity line of credit. A lot of people don't understand how to utilize that and how that could be an aspect to help pay down the primary mortgage, but also how to utilize that to put your house in a different situation to increase the value. So some members are in the that we deal with are at that cusp of, well, our family's growing and we were thinking about upgrading, meaning getting a larger house because our family's growing. Well, that makes sense. Can we use a HELOC? Are we in an economic situation where we can use the HELOC to make some adjustments to the house to increase the value? Yes or no? That's part of the decision-making process where, a year ago, 2 years ago, you didn't have to do anything to your house, sell as is, and you're getting competitive offers left and right. So why would you put money into the house? People are going to buy it as is, and they're competing. So this was a big thing in California. I had some clients when I was still living in California that were like, well, Bob, we're going to have to put about 30 to 40,000 into our house and to get it sellable. I'm like, well, that may have been true when you bought it, but you may want to talk to a real estate agent now and see what the market's like, because you may be able to keep those dollars in your pocket and not put money into it. And at that time of the economics, that was the case. In fact, I think they got what was like 10% above their initial asking because of the competitive market. So not only did they get 10% more than what they put it out, they still kept their cash they originally had. Right? So these are all things that are part of this equation of trying to figure out, do I pay off my house? Do I not? What's that look like? Is really, this is a logical financial decision that requires a plan to be executed, understanding what are the different scenarios that could occur to allow for the end goal, which is, that depends on the member, right? Depends on you. What is your end goal? And that's what we want to make sure we accomplish, not just we got to do something to do something, or somebody said something and we should do that.
It just feels good to have no mortgage. So as people are assessing this, like, what are some questions they can ask themselves to determine, is this the right move for us?
Yeah.
Or when?
Yeah. I think the biggest thing is what's your discretionary income look like? What's your monthly cash flow look like? Meaning you have an income, you pay money, you have expenses. What's the leftover? Also, what's your current situation with your equity in that particular property, as well as the equity in any other real estate properties that you may have? What other assets do you have? Do you have a brokerage account? Do you have some emergency money sitting into cash? Do you have cash value life insurance, right? These are all assets that have liquidity available that can help with this decision and allowing for the outcome that you're looking for. So those are some personal homework steps that you can take. And this is stuff we take all of our members through, right? We go through this process, the cash flow map and the asset map to find those dormant dollars. Is all I'm saying is that go through that assessment. Now, if you're not sure how to deploy, you do that and you're like, okay, well, awesome. I've got money. What do I do with it? Well, then that leads to a few other questions and scenarios. That's where the technicality comes into play, right? That becomes where a plan of execution that meets your scenario, your outcome, and what steps do we take? And so that's really something that we would end up we would do. It's hard for me to say, oh, go talk to so and so, go talk to so and so, go do this, because they don't all have the knowledge or the plan design that we do with our members. But that would be the first thing, and decide on, okay, does it make sense to, we do have some members, as a side note, we do have some members that have, 5-6% interest rates still. A lot of them still are at 2 to 3.5%, where that money's cheap. But so it really becomes but it's still 2-3% of your dollars on top of the tax. And most of our people are at the top tax rate, 35-37%. So is that 2 to 3% still cheap? Right? So.
And you just don't think of it that way, or they don't, So it sounds like everything else we talk about, it's about being purposeful and having a plan. And the people we deal with do have that extra cash flow in almost all cases. It's like they're making a good living, they're putting aside money for retirement, they're living the life they want to live, but then each month they still have this extra money and they're like, what should I do with it? Do I pay down my mortgage? Do I invest? And it's overwhelming and they're not sure. So then we see so many of our members who just have this money sitting, like you said, dormant, not working hard enough for them. So that is really where the planning comes in. So thank you for enlightening us on that. Thank you, Doc, for being here and listening. We hope it's been educational. And I think this is a topic we can definitely do some more episodes on. You said so many things there that I would like to dive deeper in. So Doc, if you enjoyed this episode, please share it with your peers. We are so excited to see our listenership growing. If there's a topic you want us to talk about, send us an email, drop it in the comments below. And thank you so much for being here. Till next time, go be a wealth maverick.